And good morning. Welcome to the SBDC Business Credit Secrets Revealed. I'm Mac Young. I'm the manager of Capital Access here in the Springfield office. We're going to spend some time today not only taking a look at business credit, but we're also going to look into some personal and consumer credit. Hopefully, by the end of today, you'll see how valuable it is to not only monitor, but also work on improving your credit scores, both personally and for your business. So personal credit, it's a good place to start, right? Since for the most part, personal credit's going to be an even playing field. Now, I don't mean that everybody's going to have the same score. It's not that kind of field. But we can all agree that everybody has credit. Whether it's good, bad, or indifferent, we've got credit. And so we can choose to take an active role to monitor it, or we can live with the consequences of not having an active role in monitoring it. So no matter what, proper debt management and credit management could have an impact on somebody's financial life as if they were picking two winning stocks in 1 year, right? So it really pays off, sometimes thousands of dollars, to have a good idea of where your credit score is. It's important to remember that a credit score is going to be something that's based off of past events. It's your payment history. It's what you've done in the past or maybe what you haven't done. Some things positive, some things negative will show up in your credit report, but it's not who you are right now. You can always take active steps to monitor and manage your credit and to help it become more positive impact for your life. Now, as some of you may know, it is a little bit easier to destroy credit than it is to build credit. Building credit takes time. There's readily available information about all sorts of credit, whether it's business credit or personal credit, online. You can read books from the library. You can use a service like Credit Karma or NAV. You can do the research to help improve your credit score, and we'll go over what some of the benefits of doing that research and improving your credit score are going to be. But either way, you're living with good or with bad credit, and this will have an impact on your entire financial picture. We'll get into that a little bit more in depth in a few slides, but you have to realize that, our society is built on credit. Over the years, credit's taken many forms. We can talk about any type of credit, various consumer credit or business credit. There's new products and programs that come out all the time. There's mortgages, there's auto loans, there's student loans, payday loans. Almost any type of credit that you can think of has been used at one point or another. Because of its nature and because it is credit, you have to weigh the costs and the benefits. You'll find that credit's going to be a necessary evil. How would we get something in life without a little OPM from time to time? And what's OPM, do you ask? Other people's money. It makes sense to use other people's money, especially when purchasing large ticket items. But credit can also be part of your financial health, right? There's offensive and there's defensive financial planning. Offensive financial planning is what people enjoy doing most of the time. It's picking that winning stock or buying that cryptocurrency that's going to double or triple in value. It's the fun part of financial planning. Defensive financial planning has a lot to do with insurances. You've got liability coverage for your business. You've got it for your personal life, home and auto, things like that. Today we're going to take a look at some of the different scores and what they could translate to in your life. So if you look at the infographic up on the screen, what's a good FICO score or what's a good Vantage score? Well, FICO and Vantage scores are two measurements that the large credit card companies use to weigh the type of credit risk they think that you are. You'll see that both of these scores go from about 300 to 850. Now, in the credit world, most of the time, a higher score is better. It means that you are a better credit risk. It means that they will offer you different programs. Could mean that they'll offer you some credit that's just not available to other folks. So what can good credit help you achieve? Well, number one, good credit could give you significant savings on the interest rate on big ticket items. Think of buying a house. Think of taking out a large business loan. Thinking of financing an automobile. People with the higher credit scores generally get a lower interest rate. With a lower interest rate, you can save thousands of dollars, sometimes tens of thousands of dollars on what you're paying for. You can get better terms and availability on loan products. Some creditors, banks, and institutions offer different products to people with high credit compared to people with mediocre or even lower poor credit. You could also get access to the best credit cards. You can get potential cards with 0% interest rates as an introductory rate or balance transfer options. You can get a credit card that allows you to get points to travel or participate in other reward programs. There's lots of different options for people with better credit when it comes to credit cards. Insurance discounts. Now, you cannot be denied insurance because of poor or lacking credit, but it can change the premium or the amount that you pay for your insurance. You could potentially have more housing options, right? Some landlords at some of the rental management companies consider a potential tenant's credit worthiness before they have them come in to move into their building, right? They're going to want to make sure that you're going to pay on time. Security deposits and waivers with utility companies. Some utility companies may consider your credit when they're going to determine how likely you are to pay that bill. It could result in a deposit that needs to be paid. Options are good in most situations to try to have better credit as opposed to having mediocre or poor credit. And over time, you can build the new credit that you need to help you achieve some of these goals. So what's credit made of, right? Well, so if you take a look at this infographic, this is specific to the FICO score, but it breaks down similar to this no matter what you're using. You'll see 10% comes out with new credit, and then the mix of credit, meaning if you're going to take some new credit card or open that up, or if you're going to take out a new auto loan, typically doesn't have a huge impact on your credit score. Your credit mix also doesn't play as large a role as some people would think. Credit mix can be a mix between paying off your student loans, mortgage, business stuff, any of those things. But at 15%, the length of credit history starts to take effect, right? It's worth 15% of your score. And so the longer you've had established credit that shows a good payment history, the more strong that number is going to become. 30% goes to the amounts owed, right? What's your balance when it's compared to the limit that's available on your credit card? There's a lot of people that say in the consumer world that 30% of your available balance limit is going to be a determining factor in your score going up or down. Now, the scores change all the time, so no big deal. But the biggest part, the one that is most important is payment history. You're going to want to, no matter what type of credit it is, credit card, business, personal, consumer, or mortgage, pay all the time and pay on time. There's also some different variations for credit scores. Some of these variations are used for home loans, so mortgage. Some are used for automobile or home insurance. Commercial lending is going to use a couple different variations too. Equifax, Experian, and TransUnion are the large credit reporting companies that report on consumer credit. Now, you'll also see that two of the three, Equifax and Experian, are going to be heavily utilized in business credit planning as well, and we'll get into that a little bit more later. So what can good credit get you? It's important to know this. Like I said earlier, this can potentially save you thousands of dollars, sometimes tens of thousands, and if you can see the first part of the screen up there for the infographic, it goes over a mortgage, and a mortgage that has a 30-year term with various interest rates that correspond to having good credit, mediocre credit, or poor credit. And we'll take the two extremes. Somebody with good credit can save a little bit on their interest rate, and they wind up paying on a $150,000 mortgage over 30 years, $233,000 for that mortgage. Somebody with bad credit for the same $150,000 loan winds up paying $283,000. It's a difference of about $50,000. It's a lot of money. Now, granted, the average person only keeps a mortgage for about 7 years. So is there any cost savings for shorter term products? Well, yeah, if you look below that, take a look at the auto loan. The auto loan for somebody with good credit and this is an auto loan of $30,000 with a 5-year term, 60 months, winds up paying $32,667 for that vehicle. So that means they're paying $2,667 in interest above what that vehicle cost. Somebody with poor credit ends up paying almost $42,000. So that's a huge difference, and we're talking a big difference over just a 5-year period. Now, with better credit, you're also going to have access to different credit cards like we discussed, and you'll have access to different rates and programs on those credit cards. One of the things that was most interesting to me is the insurance rate or the premium difference. Now, this example up on the screen at the bottom is for insurance rates for a 30-year-old driver, no real accidents or speeding tickets, a slightly used car, and only drives about 12,000 miles in a given year, and they're all city miles. Now, his premium with good credit's $1,500. His premium with poor credit is $2,580. You can see that just having good credit in the span of a year could save you $1,000 or more sometimes, it just depends, on something that everybody needs, something like car insurance. So let's get started with some of the business credit, and obviously it's key to start this journey by trying to build good personal credit. For most small business owners, you're going to use your personal credit to help establish your business credit, but there are still some things that you can do to help start your business credit off on the right foot. So obviously, you want to start with a good foundation. You want to be able to establish credibility. You can do that a couple of different ways. First off, you're going to want to get on the map, right? Just because you've opened up a business or you're potentially opening up a business doesn't mean that people know that it exists. There's a few ways you can get on the map. You can register your business on Google. We encourage you to get a business phone number and then register it with a 411 or a phone provider. So that way you'll be providing information so that eventually credit card companies or that eventually credit bureaus will pick up on that info and they'll tie it back to your company. You're also going to want to open up a business bank account in your official, business legal entity's name, and then you're going to make sure that you've established your business. In establishing your business, you're going to want to register, get an EIN. So if you haven't already, you should seriously consider getting incorporated or setting up an LLC. By adding an Inc. or an LLC to your business name, you'll be legally separating your business from your personal credit profile and assets. It starts that process going. If you choose not to do this and you continue to operate as a sole proprietor, then you do run the risk of potentially having somebody attaching themselves to some of your business assets should you ever get sued. The Federal Tax Identification Number, or the EIN, is basically a social security number for your business. So given the steps above, it's fairly redundant, but nonetheless important to say that by opening credit cards, lines of credit, and bank accounts in your business's legal name, you start that separation process. So you're going to want to make sure to spend money from your business checking account rather from your personal checking account on business expenses. Clearly separating your personal stuff from your business expenses also makes it much easier to manage during tax time. Now, at some point in the process, when you're working through the steps that we've just discussed, you'll have to have an honest conversation with yourself, right? You're going to have to figure out and gauge to think if you think that you are a safe risk, right? And if you're not sure how you can tell, then ask yourself a couple of questions. Do you pay your bills on time? It's probably the number one credit rule in any situation. Paying your bills on time shows that you're reliable and that you can effectively manage and pay off your debt. Now, a late payment history, especially severely delinquent payment history, will bring down your business credit rating and negatively impact any of your business credit profile. Now, you want to establish good relationships, right? Now, I'm not talking about relationships with friends and family, things like that. People at church, great. You're going to want to establish good relationships with vendors, You're going to want to have good suppliers. In the world of business, a solid line of credit with one of these vendors or a supplier can be like gold. It can be the difference between having to pay right now the cash that's just coming into your business or being able to manage your cash flow cycle more efficiently to be able to run your business in order to grow and take advantage of some credit extended from certain organizations. The better your relationship with these suppliers and vendors, the greater likelihood they're going to extend to you not necessarily net 30, but net 60 or 90 terms. And sometimes that's industry dependent too. So you're also going to want to make sure that you take out a lender's perspective, right? It can be valuable to take a step back and think of how a banker is going to take a look at your situation, to think of how an underwriter is going to pick apart some of your financial statements, things like that. If you ever see yourself needing to sit across from a banker at some point, it's better to start to plan for that right now than to have to wait and to do it and scramble when you need the money, as opposed to doing it proactively before you need the money. So we're going to talk about fundability, right? So fundability, unique word, right? Look it up in the dictionary and you'll soon find that it's not there. I did it online this morning. Fundability, although you can't see it, some of the alternate variations underneath it, one of them's bankability. And that's pretty much what this is. You're going to want to make sure that your business is bankable. You're going to want to make sure that you set up business accounts. Setting up your business and registering it and getting those business accounts in your business entity's legal name is a good first step. You're also going to want to make sure that you set up credit. Now, in this instance, I'm not talking about going to get credit cards for your business or taking out a business loan. I'm talking about the various ways that you can open up your credit profile. You're also going to want to figure out a way to do business assets. You're going to have business assets to show something of value, so that way you'll have collateral, so then you can more easily take out some business loans. So a couple of things back to the credit from above. When opening up your credit file, you'll notice sometimes that over time, for whatever reason, just through the natural course of business, that potentially your business could already be registered with an open credit file. Meaning, if you go to Dun & Bradstreet, Experian, or Equifax and type in your business information and your address, you may find that they already have information that they're reporting on you. The reason that this happens most often are these credit reporting agencies actually pull information from various sources. They take a look at the state Secretary of State business filings. They correspond that with the Uniform Commercial Code filings. They take a look into state and local and federal government documentation, who's taken out an EIN number. And one of the best ways that they'll be able to tell is if you're working with a supplier or a vendor and maybe unknowingly that supplier or vendor is already reporting to one of these agencies. That will open a credit file for your business. Whether you know it, whether you like it, or whether you're monitoring it, it will be open. Now, if you do your business search and you realize, hey, you know what? I don't have a profile on any of these credit reporting agencies' websites. There are a couple steps that you could take to potentially have your credit file opened. The first thing that you could do is you could go register for a DUNS number. When you get your DUNS number, you'll be able to open up your credit profile with Dun & Bradstreet, and then make sure that after you do that, you start to work with vendors and suppliers that are going to report to Dun & Bradstreet. Typically with Dun & Bradstreet, it is vendors and suppliers who do the reporting there. If you don't work with vendors or suppliers that report and you've gone through the trouble of opening up your business credit file, it will show that it's been incomplete and they won't have enough information to actually have a score or anything like that. So you're going to want to make sure that if you're serious about opening up your business credit profile, that you not only do that, but you start to work with vendors and suppliers who are going to report to this business credit profile. You could also potentially go to a bank and take out a loan, or you could go to another supplier or vendor who reports, and just the very act of taking out debt with a supplier or vendor that reports will open your credit profile for Equifax or Experian potentially. So, business revenue. So business revenue, you're going to have to show cash flow or this is going to be a no-go. Outside of some of the recent programs with the government that they offered through COVID, if you can't show cash flow, you're not going to get money, whether it's a loan or a grant or any of those things. So it is possible to have profits and no cash flow, but it's also possible to have no profits and cash flow. It's an interrelated cycle of profit and cash flow that helps your business create that fundability. It probably comes as no surprise that small businesses typically have a harder time getting funds or getting credit than larger businesses. One of the major challenges that's identified is cash flow and the proper management of cash flow. So as a matter of fact, on average, a small business's daily income, what they bring in, is just $7 above their expenses. And that varies for different industries. If you're taking on the low side, personal services industries, a daily in is $219, but the daily out is $216, meaning they've got a net income of about $3 a day. Healthcare services, you're going to see that gap widen a little bit. The daily in is about $598, but the daily out is $577. So that's a net income of $21. Repair and maintenance facilities, net income is about $6. Retail's $4, restaurants are $11. So you can see that cash flow management can be key to a lot of different industries. And then we're always back to where we started with the owner's credit history, right? Owner's credit history for small businesses will almost always play a role in how easy it is to establish credit and get things off on the right foot. Your personal credit score will always be a factor when you're a small business owner, but your business credit score is just as important, and you can take some steps to figure out how to grow it and monitor it. And some of those things, it's important to know what these companies are looking for when they're looking at your business as a potential credit risk. So, business credit scoring factors. Obviously, like we've said, it's a recurring theme that payment history is huge. So past payment behavior is one of the number one things that consumer credit and business credit takes into account. On the business side, they also take a look at financial ratios, right? They want to understand how money flows through your business, how much you've got tied up in inventory, how quickly your cash flow cycle comes back, and things like that. With a financial ratio analysis, you'll be able to figure out how you compare to industry norms and different benchmarks for the type of business that you're setting up. Maybe historically, the industry that you're in is a slow pay with certain aspects of the business. And so if you're comparing that number to a business that's not necessarily a slow pay, then you could get misinformation or think that that's not a creditworthy business, when in fact, it's just the industry norm. Business sector and industry conditions, right? Depending on the economy overall, certain businesses or banks may find different industries more favorable. It just depends. Obviously, insolvency, bankruptcy, judgments, and legal proceedings all have a huge impact on your business credit score. And then inventory or indebtedness. How much money do you already have on the books, and what's your situation look like for the financial profile of your business to be able to pay that money back? Business age and demographics. We all know that for startup businesses, it can be a little bit difficult to find financing for a startup or a new concept idea, even though maybe what you're trying to start is a restaurant. And we know there's certainly a market for restaurants in the area. Being a new business is still quite the risk and can have an impact on credit scoring risk factors. lines of credit that you've used and applied for. If you have a record of applying for lines of credit and it shows up in your business history, then yeah, it's just like your personal history. You can tell when somebody's been to the car dealership to try to buy a car because their credit's been pulled a dozen times, sometimes. And so they're going to want to figure out how much you're seeking from other places and if you have a habit of doing that. Late payments, obviously a big deal, and then collection rates. All of that information is key in determining some of the business credit scoring risk factors. So let's cover some information from some of the specific different credit reporting bureaus for businesses. We'll start with Experian, right? So Experian collects credit information from suppliers and lenders. They also look at information available to the public record that includes legal filings from local, county, and state governments, as well as information from credit card companies and collection agencies. They also look at corporate financial databases and other databases, basically web data mining. Experian gathers a lot of data from banks too. They're going to want to know if you're paying the banks back, what your daily average balance is, things like that. How much payment habits do you have? What's your overall financial picture look like? They're going to want to also know how much credit you use compared to your available balances and things like that. They'll cover any details of current liens, judgments, and bankruptcies. How long have you been in business? What's the size of your business? What industry is it in? It is one of the most comprehensive reporting agencies when compared to the other two. Now, it has two different credit score ratings and uses a few other ones, but these are the big ones. The Experian Business Credit Score ranges from 0 to 100, right? It's not like your personal score that can go up to about 850. Same key is right for this as it is for others in your personal score. The higher the score, the better. For example, if you have 0 to 15, that means you're a high risk. You're probably not going to be so successful getting loans or getting money out of banks and things like that. 16 to 30, you're a medium risk. 31 to 80, you're a good risk, and that's quite a long range. And then 81 to 100, you're an excellent risk, right? Experian also generates what's called financial stability risk ratings. And so these risk ratings measure the risk of a company going into bankruptcy or severe financial distress within the next 12-month period. So these ratings actually range from 1 to 5, with lower ratings indicating a lower risk. Because Experian collects both trade data and bank data, their business credit report is a lot of times, like I said, considered to be one of the most comprehensive. The second one is Equifax. Equifax uses what's called the Small Business Finance Exchange, SBFE. The Small Business Finance Exchange reports data. It's an association of U.S. small business lenders who report payment data for their small business customers. And so a lot of Equifax's information comes through banks and comes from this group of small business lenders who report their payment data. They use that information to try to gauge your creditworthiness. They also collect information from other sources, but their primary reports include payment trend and payment index. Now, this shows the business payments trends over the past 12 months and how it compares to the industry norms. So it's kind of like the financial ratio analysis, but in a nice compact report, easy to digest. The Equifax Business Credit Risk Score goes from 101 to 992. Another reason why some of these business scores can be a little bit unfamiliar when compared with the normal 850 score that we use on the consumer credit side. This score predicts the likelihood of a business incurring a 90-day severely delinquent or charge-off in the next 12 months. The score, like I said, ranges from 101 to 992, and obviously the higher the better. Equifax Business Failure Score. This one ranges from 1,000 to 1,610, and it predicts the likelihood of a business failing through either formal bankruptcy or informal bankruptcy or some other legal method over the next 12 months. Businesses will take a look at this, vendors will take a look at this, banks will take a look at this to see if you're a good credit risk to potentially get some more money or additional funds. Dun & Bradstreet. Dun & Bradstreet is important to mention because of the big three. It's the only credit bureau that focuses exclusively on business credit. They report primarily on how businesses interact with vendors and suppliers, which is why potential suppliers often look at a Dun & Bradstreet credit report before they offer your business credit. In addition to business data submitted by suppliers, Dun & Bradstreet also looks at public records and other historical data to help them come up with what's called a Paydex score. Now, you'll see that their Paydex score is on a similar 0 to 100-point scale. And basically, this reflects how reliably you've paid your bills and kept up with your financial obligations. Like I said, primarily to suppliers and vendors. If you're current with your suppliers who don't report to Dun & Bradstreet's, it doesn't matter. It's not going to help you out. One thing that you can do is choose to work with, as a business, those who report to Dun & Bradstreet, or you can always ask a supplier to begin to report to Dun & Bradstreet. You know, it's interesting. Of about the 500,000 businesses who are suppliers around the U.S., only about 10,000 actually are reporting businesses. So some of the other scores that Dun & Bradstreet uses is the delinquency predictor score. Now, this score measures whether or not a business is likely to pay their bills late or go bankrupt within the next 12 months. They also have a failure score. This score is designed to predict the possibility that a company will seek legal relief from creditors or go out of business in the next 12 months. A supplier evaluation risk rating. This is what they're looking at when a potential supplier is going to pull a report from Dun & Bradstreet. This rating predicts the likelihood that a business might stop delivering its goods and services over the next 12 months. D&B rating. D&B rating relies upon the company's financial statements and other information to develop an overall rating for business creditworthiness. You want to make sure that your Dun & Bradstreet credit report for your business is as up-to-date and accurate as possible. Checking into that and figuring out if there are any errors or inconsistencies and helping to correct that can go a great way to manage and improve your score. So, with all of the three different credit reporting agencies for small businesses, it's also important to figure out how long some of this information stays on your credit report. Maybe your business has been in business for a long time. Maybe your business is a brand new startup. But generally, it's important to know when stuff drops off. Now, these are all general timelines, but they're pretty accurate for the three major reporting companies. So, any type of trade, bank, government, and leasing data that's going to fall off your credit report after 36 months. Any UCC, Uniform Commercial Code filings, is going to be on your credit report for 5 years. Any tax liens, collections, judgments, they'll stay on for 6 years and 9 months. And then the long one for everyone is bankruptcies, 9 years and 9 months, which is quite a long time. Now let's take a look at some of the different type of credit that a business could potentially either apply for or have access to. And the first one that we're going to start talking about is vendor credit. Vendor credit allows any business to get products and services now and pay later. Obviously, the goal is to delay payment as much as possible, but typical terms are net 30, net 60, or net 90. When applying for vendor credit, we always say use your EIN that's been and a verified 411 listing, meaning use your business's social security number, not your own when possible, and make sure that you give them your separate business phone number. Having a separate business phone number and separate business address that's consistent and not always changing makes it easier for any of these reporting agencies to track the creditworthiness of your business, but also to make sure that you're tying this vendor credit to your business and not to anything personal. So like we say, don't try to apply with your social security number. They may require it, and if that's the case, that's fine. But you're going to want to remember to set up a few of these types of accounts. If you have a couple of them reporting to these agencies, they'll have a more holistic, better score that they'll be able to report because they'll have more data provided. So sometimes people say maybe 5. And then be patient, right? Because of the terms for some of the vendor credit, it's not going to report every month. And so it does take some time to build up a good history of reporting for business purposes. Revolving credit, right? It has a larger impact compared to vendor credit. Now, revolving impact has the larger impact compared to vendor credit because of how it reports, right? It reports at least once a month, right? And you're going to want to make sure that you always pay the minimum due or more. For example, if you're paying the minimum due on your credit card, then it'll tack on a good payment history. If you pay less than the minimum due, then it'll say that you have some late charges and late fees. If you pay more than the minimum on some of your other debt services, maybe it's a loan or anything like that, then it'll go straight to principal and you'll end up paying less interest. So you always want to be available of, especially with credit cards, the available balance to the limit. Make sure that you keep it as low as possible, but that you're also monitoring it. So that way, let's say that you're not spending, if your credit card has a $1,000 limit and the balance that you carry on it was $700 in one month, and then the next month it's $900, well, then the next month after that, it's going to be $1,100. And although they may allow you that extra $100, they're going to charge you for it, and they're going to report that, and it's going to show bad for your business credit score. Some recommend a few credit cards or a couple of credit cards, a few vendors' lines, and then some sort of a bank loan for your business to be able to build a holistic credit image for potential use. Some other options for different types of credit are traditional loans, right? And some of these loans are going to be offered through the Small Business Administration, banks, online finance, short-term lenders, things like that. So if we're looking at some of the traditional and SBA loans, you're going to notice that they've got higher loan amounts, right? $5 million. They average, though, around $330,000. The time to apply can take a little bit of time. So if you think you're going to need money and you're going to pursue this avenue, you need about 3 to 6 months to go through underwriting, working with a bank who's certified to be able to do those type of loans, or working with a bank in partnership with a nonprofit, depending on what type of SBA program that you're going to be going for. You can pretty much use the money for about any business use, and then the terms can go 3 to 10 years, but it depends with real estate. It can go up higher, 20, 25 years. You will be making monthly payments. Traditional bank loan is $150,000 and up. If it's a good risk for the bank, they don't care how much money they're going to be loaning out if the deal makes sense for everybody. Their underwriting's typically quicker, 2 to 4 months, and you could use it for any business use permissible by that bank. It depends on the term. Terms are going to match collateral. So if you're going for real estate or hard fixed assets, larger equipment, then you can have a longer term. But you can also get shorter terms available too. Those are going to be monthly payments. And then obviously your annual percentage rate or your interest rate will fluctuate based on your business's credit score. You can do line of credits or term loans up to various amounts. Those are quicker to get. If you need the money fast, you can do that with a traditional bank, or you can do it online. They have different payment schedules, and then interest rates are going to vary on those products as well. Short-term lenders for invoice factoring and merchant cash advances, all those are options, but some of those options can be thought of as expensive money. So now we also offer, as the Small Business Development Center, access to a few revolving loan programs here at our center. So we have 2 city revolving loan programs that are specific to the geographic area of Springfield. Those loan amounts for us are typically larger than our other loan programs, and we look to partner with a local bank to be able to share risk to help get the job done. We also have a city microloan program that's going to be for loan amounts $5,000 and under, and can really help be the catalyst for a small business who is looking to learn more about credit, start to build credit, or start to show a good payment history. We have one county loan program that is situated to help businesses outside of the city limits, out in Clark County. And then we have childcare and revolving loan programs. There's a lot of different options when businesses are starting to seek funding, or when they're looking to either maintain, grow, or bring up their business credit scores. Either way, it is something that's very important for businesses, and it's something for people both personally to be able to know what goes into their credit score, to be able to take the steps necessary to help move that credit score up. A couple of last minute tips. You need to monitor your business credit. You also need to monitor your consumer credit. With the internet and with all the information out there that's readily available, this is becoming easier and easier. Your business credit report, unlike your personal credit, is something that you could potentially have to pay to get a report of. You can pay for a report from any of the three that offer it, or you could potentially pay for a service. Dun & Bradstreet, Experian, Equifax, they all offer a pay to monitor your credit report for your business type of a service. And then there are other options. You can work with a nonprofit or fintech company, whether it's NAV, Financial, or BetterFin, to help monitor some of the business credit reports and scores. You're also going to want to monitor your consumer credit. You can get a free credit report from each of the large three bureaus once a year. So it's important to get one of those reports, download it, take a look at it, check it for accuracy, and then make sure that if there is anything that's inaccurate or that you wanted to dispute, that you'll contact that company directly. You can also pay for some services, things like Experian Boost or some other credit monitoring and credit alert services. That way, if anything happens or pops up on your report, you'll be the first to know. And then there are other options like a Credit Karma and some similar things where you can monitor your credit score and keep tabs on what's happening. And they'll even give you some tips and tricks on what you can do. It's important to realize, though, when you use one of the services like a Credit Karma, that it's not necessarily the same calculation as a FICO score or the Vantage score that if you're trying to get your credit pulled for a mortgage that they're going to use, or if you're trying to take out a bank loan. The score number will likely fluctuate depending on how it was calculated. So, well, guys, it's been a lot of fun. Let me know if there are any questions. Typically, for most people, when you're dealing with personal credit that's turning into business credit, the situation is very specific to you and your business. So I would encourage you to check us out here at the SBDC here in Springfield. Give us a call at our office, 937-322-7821. Ask for an appointment. Become one of our clients. We'll help you through all this stuff. We'll help give you some information tailored specific to what you need for your small business to either get it started, to help it grow, or to get you on the right track with any of those things. Thanks for your time. Hope you enjoy the rest of your day.